Hi, everyone. Mike here. And here we're going to talk about our first quarter review. It's already, 90 days. We're into March. We're into April already. And want to take a look and see what the markets have been doing year to date. Want to maybe take a look at, what's happened and what we think is going to be happening going on for the rest of the year. By the way, hopefully, as you're watching this by now, you've gotten both of your vaccinations. I know a lot of us here in the office have. And we are all keeping our fingers crossed that we can get back to normal from this coronavirus experience we've all dealt with, hopefully in the not too distant future. I'd love to be able to travel without a mask, for example, and just go to the grocery store. I don't know about you. I just personally hate wearing those stupid things. You got to do what's healthy and all, of course, but still drives me crazy. Anyway, let's go ahead and share my screen. So we're going to start by looking at over here. This is Yahoo Finance, and this chart shows you what's happened in the S&P 500, or basically the stock market over the first quarter of 2021. And you can kind of see here, mostly up and down, right? It's trending slightly up maybe for the first quarter, but barely. Not, we've had some good periods and bad periods. Just a lot of uncertainty, I guess we could say, for this first quarter. What's kind of interesting, though, is starting at the very end of the first quarter, but really getting into April, we started to see markets start going up. In fact, as I'm recording this today, about the middle of April is when I'm recording this. Most of our portfolios are now fully invested because if I click on this and I just go year to date, you'll see a slight change here. Let's go ahead and click that. At least I'm trying to click it. There we go. And notice how we've really started to take off here in April. And so it looks as though as we enter into earnings season here, what's happening is we're exiting, or it looks like we're nearing the end of COVID-19 anyway. And these companies are starting to announce pretty good earnings. They're starting to, look forward to the future with a lot of positivity. And that's going to drive markets up. So we're wanting to take advantage of that. And so now that we're in April, look at this last couple of weeks, things have been really starting to rock and roll. And so we want to take advantage of the ups or the gains when we can. Now, with all that in mind, however, there is something we need to pay close attention to, and it's this little tab right here. This is our Warren Buffett indicator. And what he does is he likes to compare the size of the stock market, or the market capitalization it's called, compared to the size of the economy. And from his perspective, that there should be a range where the market, a good market valuation, it should fall in a certain range. And so if we look at this right now, he would argue that this market is not just overvalued, but in fact, strongly overvalued, which is the highest red rating they can give. So let's go ahead and take a look at this right now. The aggregate US market is at about 50 trillion. GDP is 21, call it 22. Basically, we're at 233%. And if we look at this since 1990, you can see where we are right here. It's the highest it's ever been. And in fact, I'm going to scroll down because I want to show you this. This is that indicator since 1950. So this goes back 70 years. 70 years. And if you look at it, the market really had a good run in the 50s and early 60s, and it drove that indicator way up here. And then what happened, if you remember, the market late 60s, but especially in the 70s, like the second half of the 60s and throughout the 70s, the markets just stunk. They were horrible. They performed like doo-doo, as my mother might say. And anytime you get markets up here, this valuation up here, it usually indicates that the next 10 years is going to be a very tough year for the markets. And that's what happened here. And and then by the time you got towards the end of the 70s, into the 80s, now we're down here on the good side. This is where Warren says, this is beautiful. Things are very undervalued. This is the time to invest. And boy, if you invested in the 80s, you know what happened in the 80s and 90s. The markets just took off. And then look what happened in right around 1995. We went from below the historic trend line above it really fast. And this is really important because at that point, that's when Alan Greenspan at the end of 1995 came out and he said, the markets are suffering from what he called irrational exuberance. What Alan Greenspan was saying is like, people are crazy. These markets are wildly overvalued. They're investing like they're throwing money after who knows what. Kind of reminiscent of Bitcoin today, right? Anyway, the thing was, that was 95. The markets hit for 5 more years, they kept going up. Actually, 4 more years, rather. They kept going up. In fact, markets doubled in value after Alan Greenspan made that comment. So even though markets were roaring up, it was emotions kept driving markets up. And that was the dot-com period. And remember what happened is markets got way up here, which was all-time highs. And then the internet bubble popped. We saw the NASDAQ lose 75% of its value in a year. We saw Amazon go from over $100 a share down to like $7. It was just ridiculous. The blood in the water. 9/11 happened. I mean, but you might remember from this point right here, when it peaked, the next 10 years, the markets actually lost money. They actually lost money. Well, and then finally after 2008 crash, we're down here and Warren's like, oh my goodness, we're in buy zone again. Let's buy. And in fact, since then, the markets have been on quite a tear. But notice where we are today. We have now gone again higher than we have ever been on this indicator. So what does that mean? Markets are overvalued. I can tell you that. There's no question. Markets are overvalued. But does that mean that they're going to crash tomorrow or next week or even next month or even next year? The answer is I don't know that. I don't know. I do know that emotions drive markets in the short run. I do know that. And I do know that if you are an investor, there's not a lot of other options right now. Interest rates are so low. It's like, well, where are you going to put your money? I might as well put it in the market because heck, the dividends on dividend-paying stocks are more than what treasury bonds are paying. So those are all, we've got emotions driving markets up, coming out of coronavirus. Oh, everything should be good, right? We're driving markets up. Hey, interest rates are still really low. So why bother putting money there? Got to put it somewhere. Might as well put it in the markets. I mean, all these factors are coming together to drive markets up. But here's what I'm going to tell you. Markets don't go up forever. It's been, since 2008, 13 years since we've had a major market correction. Now, I know what you're saying. You're probably saying, wait a minute, Mike, didn't we have a 30% in March last year? Yeah, 30% drop in March happened, but then right away by like May or something, it was already made up for. That wasn't a major correction. A major correction is the market crashes and it takes a while to come back. That's a major correction. I don't know what's going to set it off, but here's what I know. Housing prices scare the heck out of me. You know what we see today? We see the exact same thing that was happening back in 2007, right before the 2008 market crash. Bitcoin, craziness happening there, just insanity. We're seeing, these online boards like Reddit, where they drove GameStop up through the roof and other companies. They're just, hey, let's just drive market price. I mean, all this stuff, it's just craziness. It is stuff that normally happens before a market crash. Although I don't know when it's going to happen. And then I've got this one for you. Now I'm back. I'm away from the charts just talking to you. I had a business conference in Nashville. On the flight home, I'm sitting in the plane. I'm flying Southwest. Now, I know some of you love Southwest. I hate Southwest. They just annoy me for so many reasons. But I'm sitting on Southwest. They're packing us in like sardines, right? They don't care about the coronavirus. They've got all 3 seats. Like the plane is packed. And so I'm sitting there in the aisle seat. And beside me is this nice young lady, maybe in her late 20s, early 30s. And in the window seat was an older lady, maybe had to be her late 60s, early 70s. And what happens is during the flight, the older gal is starting to talk to the younger gal, and she's teaching the younger gal how she should do day trading and how, holy cow, you've got to be doing day trading. This is where you're making money and how you're just missing out. And as I'm sitting there, it was crystal clear to me, with the training that I've had, that the older lady, who was very nice and very well intentioned, she didn't have a clue what she was talking about, right? She didn't. I don't know what she's doing, but she doesn't know what she's doing. She's just getting lucky right now, from what I can tell, at least based on what she was saying. What's my point? This is the kind of stuff that happens. So we want to be invested and take advantage of all of this craziness, right? While it's running, let's run with it and let's take advantage of it. But at the same time, we need to be very aware and very comfortable in moving to cash quickly if need be, to protect ourselves if things go the other direction. And that's kind of what we like to do here. So coming up the rest of the year, just a couple thoughts I have to share with you. Number one, I still think in the short term, it looks like the markets are running. Let's run with them. I think there's some major headwinds on the horizon. I don't know if you've noticed, but every time interest rates start to pop up a little bit, the markets do that really fast. That was happening back in March. Secondly, taxes. They're talking about taxes in DC. You know that as we get closer into the fall, that those conversations are going to get to be serious. I don't know exactly what they're going to do with taxes, but I know they're going to do something. And when they do that something, whatever it is likely going to create a negative event on markets. Markets are almost certainly not going to like what they do. I can promise that. It will certainly, there's a very high probability that it will increase volatility in the markets. So don't be surprised if you see news reports of them talking about what they want to do with the tax code and markets reacting in a wild fashion later that day. It would not be surprising. So in any event, we're, I think, in an okay place right now, but this is going to be a year where we have to be particularly sensitive to external events and how they might affect portfolios. But there you go. That's kind of where we're at. The year started kind of, looks like it's starting to go. And at the same time, that's great, but we want to keep an eye on things so we can protect the earnings as they come, right? All right, that's my message. I hope y'all enjoy the rest of your day, and I look forward to talking to you. Taxes are kind of getting behind us. Looking forward to talking to you here in May and June as we start really going into the tax planning side of things for 2021. All right, that's it. Take care, everybody.